welcome back. Today we're going to talk about asset valuation principles building on the present value concept that we learned in the last unit. So start off with some essential principles of asset valuation. Owning an asset entitles you to receive the benefits, which is income. The only reason investors are interested in owning assets is that the assets make them money. So when we address the question of what would we be willing to pay for an asset, we're going to look at the benefits it yields over time, and then if we can reckon the income per time period, we can simply take the present value of the income over time to gauge what we'd be willing to pay today to own this asset. And note that this procedure applies to any asset. Okay? Whether we're talking land, grazing land, how much cattle will it produce, and what's the value of the cattle crop? Cropland, what's the value of my corn crop or my wheat crop? Timberland, what's the value of the trees I'm going to cut down every 15 or 20 years? If I own homes, what's the rent per year? And if I own securities such as stocks and bonds, and then we'll move on from there to generalize the principle to any and every asset and or business you might be interested in assessing the value of in order to see if it's a good investment or not. Okay, so let's review the fundamental valuation model, and then we'll see how it applies. Today we'll look at bonds and stocks, and then in the next lecture we'll generalize it and apply it to those different asset categories. Present value of an asset is simply the discounted future cash flows. In fact, you'll hear this term a lot if you stay in the world of finance, DCF, discounted cash flows. Well, cash flow 1, cash flow 2, cash flow in for however many periods there are, however many years we think the asset's going to last and produce income. So we're taking all the stream of future cash flows and we're discounting each one. Just remember what discounting, finding present value was dividing by the growth factor to the nth power, where n is the number of periods. So the cash flow of the first year discounted by an interest rate, which we have to decide upon, over 1 year. Cash flow from the second year discounted by the same interest rate for over 2 years. On and on and on until the cash flow from the nth year, let's say there's 10 years, so the 10th year's cash flow divided by the interest rate growth factor to the 10th power. Okay, so that's all there is really to the model. Now when you get into different kind of assumptions about the shape of the cash flows and the length of the asset, it can get a little more complicated, but we'll kind of stick with the simple version of this, even when we do problems in Excel, which will make the calculation part really easy for us. Okay, so with this fundamental valuation model in mind, we can move into applying it to valuing bonds. Now before we go to bond valuation problems, we need to make sure we are familiar with how bonds operate. So let's start with some bond vocabulary. First off, the principal amount of the bond is the amount of money on which interest is paid. It's also known as the face value or the par, and it's also the amount the bond investor gets back when the bond matures. Maturity date, the bond ends, and the borrower, the issuer of the bond, makes the final interest payment and repays the principal / face value. It's typically $1,000. And of course, if a company wants to borrow $1 million, they just issue 1,000 bonds. Coupon is the interest payment. So if we have a 5% bond, the interest payment is 5% of $1,000, which of course is $50. So we would say that bond has a $50 coupon. The coupon rate then is the coupon payment expressed as a percent of the bond's par or principal. So that $50 coupon would translate into a 5% coupon rate. And then the coupon yield. Now the coupon yield is often different from the coupon rate, as we'll explore here in a few minutes, because the bond's value could rise or fall in the market. So we divide the coupon payment by the market value of the bond, and that gives us the coupon yield. That'll be higher or lower depending on whether the value of the bond decreases or increases in the market. Okay, now we can apply the present value calculation. The bond price is simply the present value of all the coupons, the interest payments, and then the present value of the principal that we're going to get at the end of the bond. So you can see we're going to be discounting coupons according to however many years they occur into the future, and then discounting the principal according to whenever the maturity date of the bond is. So the first coupon, the first year's coupon discounted by 1 year, the second year's coupon discounted by 2 years, and then however many years there are left in the bond. If it's a 30-year bond, there could be 30 years left. So N could be anywhere from 1 to 30 years. The coupons, and then the M here refers to the principal, the value at maturity, which is, as I mentioned, typically $1,000. Discount that all back to the present and then add those up. So here's an example, kind of a graphic example. We have a fictional company, Worldwide United, paying 9 1/8% coupon on $1,000. So that would be an interest payment of $91.25. And notice that occurs every year from 2009 when it was issued till 2019 when it matures. Now, our required return is 8%. You might be wondering, why is that different from the rate the bond's paying? Well, the presumption here is that in the time since this bond was issued, generally interest rates have fallen. And so now the best rate we can get on similar bonds, on similar investments, is only 8%. So that now is the appropriate rate to discount the payments by. And that's a really important concept in valuation. What is the appropriate discount rate? Well, it's typically the best alternative investment return. So if we're comparing Worldwide United to a similar quality corporate bond, and those bonds are currently yielding 8%, we'll want to discount Worldwide United's bonds by 8%. So the first coupon payment reduces to 84. The next one's 78. Remember, the farther out we go in the future, the bigger the discount factor, because we're taking the cash flow divided by 1 plus R to the n, and the n part is growing. So as n grows, the bottom of the ratio grows, and that makes the overall result smaller. Okay, then that value gets smaller and smaller and smaller as we get out to the final years of this bond, the 10th, 9th, 10th year. Adding all of those up, $651 present value of the future coupon payments, and then discounting the $1,000 principal payment at maturity, that reduces to $428. And therefore we get a value of $1,080. So if this bond is available for less than $1,080, if it's available for $1,050, it's a good deal. Buy it, because we're basically gaining an instant $30 profit. If it's only available for $1,100 in the market, we're not going to buy it. It's a loser. We'll buy something else that'll give us a better yield. Okay, and an important concept when we're talking about bonds is yield to maturity. This is the return investors would get if they held the bond until maturity. Now, if the bond's selling at par, that's equal to the coupon rate, because if you paid $1,000 for the bond yielding 8%, for instance, you're going to get $80 per year until maturity. Well, that's going to work out to 8% of the amount you invested. Typically the case, though, that bond values will vary from par due to interest rates moving up or down. So to calculate yield to maturity, we'll just find the discount rate that equates the present value of the bond's cash flows with its current price. So if I paid $900 for a bond that has $50 coupons, I'll just plug in $50 coupons, $1,000 principal into the present value calculation, and then adjust the discount rate until the present value equals the current price. We might work a problem like that in the homework. Okay, premiums and discounts. It can and often does happen that the coupon rate will vary from the required return. And a note on this, when we say required return, that is similar to what we just mentioned with the discount rate. That's the rate we think we can get today on a similar asset. Now that's often going to vary from the coupon rate on a bond because interest rates change. So the bond's price will have to adjust to reflect, to make the coupon payment of the bond basically equivalent percentage-wise to whatever current interest rates are. So here's how that works out. R, the required rate, which we could view that as kind of today's interest rates, the discount rate. If that's greater than the coupon interest rate, the bond's price is going to have to decline below par value, and we'll say the bond's trading at a discount. Today's interest rate is less. Interest rates have fallen, so today's interest rate is below the coupon interest rate. This bond's going to go up in value because it's got a more attractive yield, and the price is going to go up until the yield on the bond equilibrates to today's interest rates. More on that in a few seconds. Some notes on discount rates. The greater the uncertainty about the asset's future benefits, in other words, the greater the risk of the ability of a company to make its payments on its bonds, the higher the discount rate investors will apply when valuing the bond, discounting the payments. And this is just that risk-return principle again. Higher risk requires higher return. And in the case of bonds, we're talking about the interest rate on the bond, or more properly speaking, the yield on the bond. Okay, now, what affects bond prices? The basic thing is the change in interest rates. But there's also a few other factors to consider. Time to maturity. Bond prices converge to par with the passage of time. If the bond pays off tomorrow, we're barely discounting it at all. One day is not going to be much of a discount factor, so it's going to be very, very close, if not equal to par value. Whereas if the bond has 100 years before it pays off, well, we're discounting the bulk of the coupon payments and the principal payment by a substantial discount factor, so its value is going to be far less than par. So you can see the longer the time to maturity, the more discounting is going to take place and the lower the present value of the bond will be. As I mentioned, interest rates are the biggie here. Bond prices and interest rates move in opposite directions, and we'll reflect some more on that phenomenon. It's one of the most important things to know in finance, actually. The fact that when interest rates go up, bond prices and actually asset values in general go down, and vice versa. And the change in interest rates has a larger impact on longer-term bonds and short-term bonds and longer-term assets in general than shorter-term assets, due to the fact that there's more discounting going on with long-term bonds, and the interest rate is one of the factors in discounting. The idea that bond prices or asset prices and interest rates move in opposite directions, I like to refer to that as the Bocephus Principle. And I get that from the first few lines of one of my favorite country songs by Hank Williams Jr.
Says it's the end of time, and the Mississippi River, she's a going dry. The interest is up and the stock market's down, and you're only getting mugged if you go downtown.
And the principle can be stated generally in this way. So in that song, Hank Williams said the interest rate's up and the stock market's down. And that may be just kind of a rant of a disgruntled guy, but it expresses a truism about the world of finance. And we can generalize that by saying asset prices and interest rates move in opposite directions. So if interest rates are up, it is typically the case that asset values, such as stocks and bonds, will go down. Vice versa is also true. If interest rates fall, asset prices will generally rise. And what's going on there? It has to do with the present value calculation of those assets. When we discount a stream of future payments at a higher discount rate, a higher interest rate, that results in a smaller present value, and vice versa. Remember the formula. Present value equals, let's just be really simple here, future value, future payments, divided by 1 plus r to the n. Now this is just that lump sum, that single payment formula, but we can get the idea with just thinking about this. If we use a higher discount rate, so if I increase the r, interest rates go up. What that does is makes the denominator of the equation larger, and if I divide a number by a larger number, the result is a lower number. So as the denominator of this equation goes up, and that can happen because of increases in interest rates or a longer discounting period, larger denominator, dividing that number by a larger number gives us a smaller result. So present value moves inversely with changes in the interest rate. Here's some more intuition on that. If interest rates fall, older bonds, they have higher coupon rates. They're more attractive because they're paying a higher coupon, a higher rate of interest. So people want them more than the new bonds, and in order to buy them, you have to pay a premium. And what's going to happen in the market is people are going to bid up the price of the older bonds until its yield, which is the coupon divided by the price, is just equal to current interest rates. Likewise, if interest rates rise, older bonds are now less attractive because they're paying a lower coupon rate, and people are less interested in owning them. They might be more willing to sell them, and then to get rid of stuff that you don't really want anymore, you might have to reduce the price. Those bond prices will fall until their yield matches current interest rates. Okay, and I know that's complicated, so let's look at a simple example. Let's say in 2016, Megacorp issues new 10-year bonds with a 4% coupon rate. That means $40, right? Because I said the face value is usually $1,000. So $40 on $1,000. And market interest rates rise in the meantime, and they're now 5% for similar bonds. So what's going on with investors? Well, for those old bonds paying a lower interest rate than current rates, we have to adjust their value so they effectively yield 5%. The coupon's still $40, so we're going to find the value at which that $40 coupon is 5% of the value. And mathematically, that's going to look like this. The $40 coupon equals 5% of x, and we're going to solve for x. So how do we do that? Well, first off, let's divide by 5%, and decimally that's 0.05. Okay, divide over here by 0.05. And if I work that out on a calculator, if you want to verify that with yourself, you can work that out. 40 divided by 0.05 equals 800. So you can see the bond's value has fallen now such that for the $40 coupon divided by the $800 bond's value, it's now yielding 5%. Now, interest rates rose from 4 to 5%. By the way, how big of an increase is that? 20%, right? We got a 20% increase in interest rates, and the bond's value falls. How much did the bond's value fall here? From par 1,000 to 800 minus 20%. So you will sometimes see a direct proportional change. In some cases, though, the change will be magnified due to the time period of the bonds. And here I'm just actually assuming perpetuity, so I'm simplifying it. But in reality, it'll look like this. The longer the period of the bond, and we see the purple line here represents a 10-year, a longer-term bond. The green one represents a 2-year bond, 6% coupon rate for both. So as interest rates rise, we're going up from 6 to 14% here. We can see that the bond value falls more for that 10-year bond. So the length of time is a big impact factor. And as interest rates fall, the bond value would rise more for that 10-year bond. So remember, in discounting, two things matter: change in the interest rate, or the magnitude of the interest rate, and the time period. Okay, let's do a little bit more bond vocabulary, and then we'll be ready to move on to stocks. Primary versus secondary markets. Primary markets is when companies issue bonds to big investors. They could be investment houses, Wall Street, banks, mutual funds, insurance companies, that kind of thing. When individuals want to go put bonds in their portfolios, or even mutual funds, they typically go to the second market, and that's where one investor will buy the bond from another investor. And then we'll wrap up bonds just by looking at a few different kinds of bonds. Corporate bonds, as I mentioned, par 1,000 semi-annual coupon. They're called bonds if they have a more than 10-year maturity. They're called notes if it's less than 10 years. I think I've referenced that terminology with respect to treasuries. Municipal bonds, also called munis, issued by local and state government. Interest on them is tax-free currently. That might change with tax reform, but I frankly doubt it. So that makes munis a little bit more attractive. And what effect do you think it has on their yield? If you said the yield is lower than similar corporate bonds, you're correct, because the fact that you don't have to pay taxes on them like you do on corporate bond income makes them more attractive, and hence people are willing to pay more for them. And as we know from the Bocephus Principle, if the value is higher, that means the yield is lower. Treasury bonds we've talked about: bills, notes, bonds used to fund government spending above receipt of taxes. That's going to be the single biggest issuer of bonds in the history of the universe right now. There's something like $20 trillion worth of treasury debt outstanding. Some of that's intragovernmental, not all of it's held by the public. I want to say right now it's maybe about 15, 16 trillion held by the public, but still, that's a lot larger than any single other entity that's issuing debt in the world. Agency bonds are government-supported agencies. Fannie and Freddie, Ginnie, those are the government entities that were created to invest in mortgages. They finance most of their operations by issuing bonds. Okay, we should also mention bond ratings just briefly. There are several rating agencies, and they grade bonds according to their perception of the risk of default. Investment grade bonds are rated in the upper levels, AAA down to B. They have all these kind of complex grades, but it's basically A, B, C. So the A, B rated bonds are known as investment grade. They're very unlikely to default, very safe. And then junk bonds are ones that are rated in the Bs down to the Cs. And they're not necessarily that much more likely to default. They just have a more significant default risk. So investment grade bonds might have a 0.05% chance of default, whereas junk bonds have a 0.5% chance of default, or 1% chance of default, something along those lines. You do see a difference in the yield. The more risk with junk bonds, and some issuers don't like the junk label. That's just a label that's stuck in Wall Street jargon for years. A kind of a euphemism for that is high yield. It goes with high risk. That's the risk return trade-off. One of my other finance textbooks has a table which is kind of interesting that shows the yield spread, or the premium on high risk bonds versus low risk bonds versus treasury bonds. So bonds that are rated AAA, they'll only pay about 10 basis points, which is 0.1 percentage point for shorter terms, or 50 to 80. So the yield isn't that much above treasury bonds, which remember are the risk-free. The government can always pay you back no matter what. And then if you look down here at the triple C, the lowest rating, well, they're going to pay something like, when the book was published, and these yields will vary over time, but they were paying something like 8 or 9%. And that also goes up with the increase in maturity. So there's quite a yield spread, and if you want more yield, if you're willing to accept more risk, you can just go down the You can go down in credit quality and buy junk bonds and get a higher yield. Of course, on average, they're going to default a little bit more often, so you got to be careful about that. Okay, so bond valuation. Remember, price is the sum of present value of coupons plus principal, and bond prices are inversely related to interest rates. So I'm looking at the clock. I think we'll stop there. That's quite enough for us to digest for the time being, and then we'll pick it up in the next lecture by comparing stocks versus bonds and applying the valuation principle to stocks. See you soon.